Hi, good afternoon. This is Mayor Valensky with Driving Markets. Anything said in this piece is an opinion only. Let's kick off. Remember, you can subscribe, share, comment, and also catch me on Instagram and on TikTok. Let's kick off very quickly. Short version, let's move on. Right, the Fed raised rates by 25 basis points yesterday. Now, they would have raised it more, and also they would have said that they're going to raise rates in the future. But let's just dig deep into what actually happened. They raised rates by 25 basis points, indicating that this could be the end of the recent or the existing rate cycle. Okay. Also, there's indications in the markets that by the end of November, by the end of 2023, around about October, November, rates will start to come down. Those 2 points, let's understand them. 25 basis points because inflation is still stubborn. It's not going down. In fact, inflation could potentially even rise. Unofficial inflation is well above the 5.1, 5.6, 5.7%. Okay, unofficial inflation is running at 17, 18%. Official inflation, which is concocted and manufactured, in my opinion, by the Fed and by the Bureau of Statistics in the US, is there to calm down the markets, calm down the individuals, and give you a feeling that maybe inflation is going down. But we all know that the real cost of living is going up. It's very expensive and it's rising all the time. Prices are not coming down, especially for foodstuffs and especially for energy. Okay, they're also being fed through to the consumer. So you might have the raw materials coming down, but those prices are not being fed through to the consumer. So the consumer feels as though that prices are going up all the time. Taking that into consideration, the Fed does not want to push the economy into recession. It knows if it raises interest rates any further, it's going to have several impacts or multiple impacts on the economy. Number one, hardship to the consumer. Number two, potential recession, or there will be recessions. It'll just be a bad recession. Price of mortgages and price of loans and or the other overdrafts and finance will increase. And lastly, it could really impact on a further banking crisis. Moving on to the banking crisis, it's already there. The start of the banking crisis was SVB, Silicon Valley Bank, leading on to Signature, then First Republic effectively went bust and was taken over by JP Morgan Chase. However, we're only the beginning of the banking crisis, and this banking crisis is going to continue. There are other banks already in the spotlight. For example, we've got Northern Trust and also we've got PacWest, Pacific West. Those two banks, for example, are in the spotlight. You're going to have Zions Bank, Zions Corporation, you're going to have Co-America, you're going to have Charles Schwab, and you've got multiple other regional banks that are now coming into the spotlight. Effectively, in my opinion, the regional banks, second-tier banks in the US are finished. It's just a matter of time so when the next one and the last one will be bought out or saved. What are the options? The options are that the top tier banks will buy them out. So you'll have the Goldman Sachs, JP Morgans, and you have the Morgan Stanley all will come in and buy out the second tier banks. Unlikely, because they don't have a spare $3 trillion, which is what's going to be needed to fund all of this regional bank collapse. Okay. Second option is that they go bust and disappear. Unlikely, because that would knock confidence within the banking sector. Final option is, or maybe more options, but in my opinion, the final option is, unless you've got more options, which you can easily comment on, is that the Fed will print more money. Okay, the Fed, US Treasury, will print more money. The FDIC, which is the Federal Deposit Insurance Corporation, they have guaranteed loan. They've guaranteed the money of deposits up to $250,000, but they haven't got any money themselves to guarantee that. They'll have to be given a load of money by the Fed in order to guarantee the FDIC deposits on account. They don't have the money. Okay, because they take a small premium from each of the banks in order to fund these guaranteed FDIC insurance scheme. So that's not going to happen. However, the Fed could print a load of money and to the tune of $3 trillion, and that would save the second tier banks, pump in more money to the top tier banks, and they'll probably come to some sort of trick or some sort of agreement whereby the first tier banks won't be buying the debt of the second tier banks. Okay, so something along those lines is what we're talking about. That will impact inflation. To the degree we'll have inflation running at 18, 19, 20%. That's on the banking sector. Okay, that's regarding interest rates, inflation, banking sector. How's that going to overall impact the economy? Well, if interest rates come down at the end of the year, which is unlikely, but for some reason people believe, investors believe, and analysts believe that they are going to come down by the end of the year. If they do come down, then that will further add liquidity to the marketplace and therefore boost up inflation, which means interest rates will have to end up going back up. We are going to go into recession, but the recent job report, the job opening labour turnover survey, just want to make sure I got that right, jobs opening labour turnover survey, reported that more jobs were created the last month than expected. So therefore there is still a high demand for labour in the US. If there's a high demand for labour in the US, unlikely we're going to go into a deep recession, but it could add to inflation, and therefore there's a whole balance going on across the board. As regards, generally speaking, safe havens like US Treasuries, which prices went up dramatically, and gold's gone up dramatically. Dollar is not going to benefit from lower interest rates or a banking crisis, so dollar is not a safe haven, just to be absolutely clear. Oil is, interesting enough, come all the way down because of expectations of a recession is pushing oil down, because expectations are that there will be less demand, therefore oil will fall flat, and that's what's happened. Oil has dropped significantly, which could impact lower inflation number at the next reading, because oil is a major component of that inflation number. Interest rates are likely to go up in the UK next week by 25 basis points at minimum. It's already priced into the marketplace. Inflation is solid in the UK, not really moving, not moving fast enough, so likely to have more strength in sterling, more strength in cable, as foreign exchange markets can see the pound is moving up. This is Mayor Walensky with Driving Markets. Don't forget to subscribe, share, comment. More than happy to give you any information you need. Have a good day.